welcome to the podcast, everybody. Thanks for joining me here on this Monday. Hope you had a great weekend. Hope you went to some type of Christmas party or something. It's that time of year. Seems like the calendar is booking up for the rest of the year. Every single weekend, Friday and Saturday night seem to be booked with something. But it's a fun time of the year. Getting some nasty weather here in San Antonio. Hopefully, when of course we need it. So we're not nobody in South Texas is complaining about the weather. But the stock market seemed to be in a dreary mood, and this comes after, of course, Friday being an almost 200-point up day, followed by the Thursday down 200-point day. So you're getting this yin-yang going back and forth. As you can see from the screen today, down 162 points on the Dow Jones Industrials, 1.3%. Transports were down, utilities were down, everything red on the screen, and all the way down. Oil service, even the gold market was down, which we'll get to in just a little bit. We're going to take a look at gold. Oil services and gold and silver were kind of the biggest losers on the day. Futures were under some pressure this morning, and then Intel came out and cut their forecasts. And then Fitch came out, one of the ratings agencies, and talked about the fact that we could see some more weakness in Europe. Right? And the stock market continued on down after that and really recovered at the end of the day, but still was a pretty nasty day. It was a 90% downside volume day. So we're seeing this really extreme conditions back and forth and back and forth. So here's the Dow. The Dow Jones, did have that rally attempt, kind of bottomed out around 11,950 or so and ended up over 12,000. So a 70-point rally from the lows. Bulls will hang on to that. The bears will say a down day. And I can just tell you from the internals, looking at this market, the down days that we're seeing are stronger, more intensity than the up days are as far as strength. So if you come back and say, yeah, but Thursday was down, and Friday we got all the losses back, and we're about even. The internals don't suggest that, and that's very important that you see what's going on. The market internals continue to get weaker, not stronger. So if you want to do some trades in here, that's fine, but the bigger picture right now is a market where you should still be focusing on the investments you have should be in income. They should be in lower volatility areas, perhaps companies that don't require the economy to really help them out. For example, Altria Group, MO. This is the American version of Philip Morris. Philip Morris PM is the international part, but MO is the American. And you can see it was up on the day. This is a stock that I bought, I believe it was early last week. May have been the week before. Can't remember off the top of my head. But bought this for several reasons. Number one, we had, of course, the stock ran up into June, hit about $28, fell back down during that nasty August time frame, and then rallied back, had trouble getting above 28 in October, and then finally got through it a few days ago, only to come back and kind of test the breakout area. And you can see it's been moving up ever since on stronger volume. Bought the stock, 5.7% dividend yield. They increase it, non-cyclical business, and because this is a U.S. company, this is a dollar play as well. Stronger dollar, MO does a little better. So, and by the way, if you look at all the stocks on the New York Stock Exchange, it's one of the best as far as relative strength, and that's very important. So if you're going to be in some companies right now, hiding out in places like Altria makes a lot of sense. For those of you that don't want to be in the market at all, then sit out. Then there's the third person out there, which is trading the minute-by-minute hourly moves. And if you did that today, I put on my Twitter that I thought we'd have a rally towards the end of the day. We did have that rally. There were some positive divergences setting up. And so when the market was down about 210, 220, I commented on Twitter that we would see some type of rally just for those that are doing day trading. And just for those that are doing extremely short term, we would see some sort of rally. And we did see that from the lows. By the way, if you want to follow me on Twitter, it's twitter.com/Carl Eggers. But it's still, again, this is, I put that out there because the time frames right now, if you're not doing the hourly trading, then there's not much to do right now. I think you kind of just be patient because the whipsaw risk is so high, right? You come in Thursday, market's screaming lower, just completely plummeting, and you're stuck. And you say, boy, I need to get out. And you come in Friday, and we get all of those losses back. And now you're out. So maybe you buy back in Friday, and then we come back today, the market's down 200 points, and there you go. And so this whipsaw risk of buying high and selling low is a big problem for people that are over trading right now. So I wouldn't be over trading. I'd slow things down a little bit, concentrate on good companies, maybe buy the fear, sell the happiness at times, but overall, don't do a whole bunch right now. Collect coupons on a lot of different things. That's what I'm doing right now. Okay, so here's the S&P 500, and we've been looking at this picture, and of course, the 200-day moving average broke through, or bounced off that, and that kind of was support for a while. Then we broke through right here, and the 200 also turned over and started heading back down. That was a big, important thing back in August when the market just fell very hard. Came up, broke through it. Everybody said, good, things are good again. But again, the 200-day moving average is still moving down at this point, and we've had trouble with it here, here, and now here. So the stock market is obviously very confused right in the short run, and it's not, I shouldn't say the stock market, these are investors, not the stock market is not a person. But you look at this and you go, well, maybe we're just consolidating, right in here, and we're eventually going to break out. That could be the case. I mean, you still have the 50-day moving average is still moving up nicely. 200's coming down, so it feels like something's going to break here. And we have this bigger wedge pattern happening. Now, a lot of people will say, hey, if we're bouncing up against the 200-day moving average and we continue to do that, eventually we're going to break through. And that is true that normally when you bounce off of support, meaning the lower part, and eventually you'll break down. Or if you're hitting resistance, the upper part, the ceiling we'll call it, eventually you will break through, and that's true. But again, that's a 50-50 game, right? I mean, when you look at this picture right here, you say, well, how do we know what it's going to do, and aren't we just speculating? The answer is yes. If you're just looking at this going, well, because it's broken through in the past based on a lot of technical studies, surely it should break through this time. And that's a losing proposition. What if you go long and this time isn't the time that it does that? So I think what you have to do is, again, I use the word internals all the time, but look at the number of stocks making new highs versus the ones making new lows, that ratio. Look at moving averages of advanced decline lines, how many stocks are going up versus down. Look at how much volume is associated with the up moves and how much volume is associated with the down moves. All these things are very important to look at, and what I'm telling you is the internals continue to get weaker, not better. So I think this thing is going to gyrate, and again, we have some seasonal factors. We've got a couple weeks left before the end of the year. A lot of people calling for a year-end rally, and we could still get that. But I would just caution you that I would love to be seeing some strength right now and reporting to you that things are getting better, but they're not. And I think for those of us that have been keeping cash for a while, we're going to get to a point where we're going to be able to use that. So the cash right now is preservation of capital, and it's a place to hide out because the lower prices will give us an opportunity to buy cheap. And remember, I mean, even if you think this market's going straight down, markets don't go straight down. They rally. I mean, look at the rally on the screen from October to November. Very strong rally. So markets don't go straight down, but what we're seeing is more weakness and a lot of people looking at these moving averages that are coming into play. And it's kind of a tug of war, and I think that's what you're seeing right now. But I did want to talk about what's going on with the European situation. Now, I've got a picture up of gold, and gold's been interesting. I've been very tempted to go long in the last few weeks, but I've continued to hold off because I didn't think there was an edge. I didn't think there was anything that was jumping out at me. And the European situation has a lot to do with this. Obviously, we have the dollar going up right now, and as the dollar has been going up on these bad stock market days, it's been affecting gold. And remember, gold had been a nice hedge for the stock market. Remember back in August here, the stock market was going down and gold was acting as a nice hedge until, remember, the Swiss came out. The Swiss franc became pegged to the euro. And once they did that, that changed the whole game. And then all of a sudden gold started trading on its own, it seemed like. And moving averages were broken there in the middle of October. And it really became just a trading on its own. And I didn't feel like I had any edge. So Don't own gold right now. But you do see what was happening here is we had this kind of this wedge forming. And so I was just basically waiting for it to break out to the upside before I bought it. And unfortunately, what happened today for those that are long is it broke to the downside. So now, as somebody sitting on the sideline wanting to get long gold, there's not an easy place to get in right now, but I think that it's going to continue to see some pressure because one of the things that's happening with gold, I think, if you look for an explanation from a fundamental standpoint, why is gold going down if the U.S. is going to have to potentially print more money and to bail all these other countries out, it seems like, why is gold going down? And I think the answer is you're not seeing the bazooka approach that everybody was anticipating. I think this is more of a Band-Aid, what they're doing right now. It's providing some liquidity and a little more certainty. But the Fed's speaking tomorrow. Wouldn't you think that gold would be up a lot today in anticipation of that? So I think what the market is telling you today is that they don't anticipate, and the stock market, by the way, that Bernanke's going to come out with some, bazooka plan, they keep calling it, where he just douses the market with more money, right now at least. That's what the market's telling you in the short run. I think ultimately there will be some type of QE3, and the ECB could start printing euros. Who knows? But I think the stock market and the gold market are telling you that's not going to happen, and they're throwing a pity party that it's not enough. And I think that's why gold is breaking down right now. So from a trading standpoint, if you're long, that would have been your stop. And I haven't been long or short, so I'm just sitting here watching the gold market right now. Now, from a longer-term perspective, this is a weekly picture. The uptrend hadn't changed, right? I mean, this uptrend here, and pardon my drawing, basically, this uptrend's still intact. So unless that's broken, for those that are long-term gold bugs, continue to hold it because nothing has changed. And I think ultimately all of what's going on here and potentially more money printing is going to lead to higher gold prices. But in the short run, I think the market gets disappointed at times. Obviously, the dollar strengthening at times, putting some pressure on gold. So for those that are long gold for long-term investment, nothing has changed. And until this trend changes, I wouldn't get overly bearish either. All right, I'm going to give you my screen of the day, and this is a screen I came up with for companies that have most of their revenue in the United States. And you say, but wait, Carl, global growth. You've been talking about it the last several years, seems like over a decade of global growth is the place to be. It is for the long run, but in the short run, I have almost zero exposure to global growth in the form of emerging markets and so forth because we know temporarily that can be derailed by fear because what happens is China's slowing down a little bit right now. Europe is obviously slowing. The U.S. is slowing. And so what happens is money starts to flow into the U.S. dollar temporarily, and that puts pressure on all the commodities and the emerging markets. So right now, in the short run, we're looking for companies with revenue inside the United States of America. And what I've got is a screen that I made of basically companies that do that, and the biggest ones, so it's ranked by market cap here. So the biggest one is United Healthcare. Then we got Express Script, Time Warner, McKesson, Marathon Oil, Northrop Grumman, Aetna, Humana. A lot of the insurance companies, Dr. Pepper, Snapple down there. Let's see what else is on the list. Gannett, Tesoro, Terra Nitrogen. And you can see the returns in the third column. And United Health, for example, up 12% for the year. Humana up 32% year to date. And I've got a column for their dividends as well. So this is the screen of the day. And basically, again, what's happening right now, we put the global growth on the back burner temporarily. And eventually we're going to be able to buy a lot of these things that we've been owning for the last several years, and the place we know money's going to flow over the long run, we will get our chance. So we own our dollars. Our dollars becoming worth more in the short term, and we're going to be able to go out and buy those very things that are going to become cheaper. Look at China. China's stock market continues to drop. Look what's happening to gold right now. Look what's happening to stocks right now. Your dollars are going to be able to buy more of that stuff in the short run over the next few months, I believe. Over the long run, we won't want to own dollars. Dollars are going to be the wrong place to be, and we're going to want to own all these different things that are building out the world. But for the short term, look at some of these companies and don't go out and buy United Healthcare, Express Scripts, Time Warner because they're the biggest ones and have all the revenue in the United States. It's not what the point of this is. This is just to give you an idea where to kind of start mining and maybe looking at some of these companies from a shorter term perspective. Thank you for joining me. Appreciate it. I'm keeping this fairly short today. Have a wonderful evening. Don't forget to look at carleggers.com is the blog. Top right, we have a free subscription. Anytime I post one, you'll get it, or an article, whatever it may be. Twitter.com/Carl Eggers. EggersCapital.com is a money management website. You can follow me on Twitter. You can also follow me on Google Plus at +Carl Eggers. Thanks a lot. Have a great evening.